in terms of the next half an hour, it's called Uncovering the Costs of an IPT Error. We've never tried to sell what we do on the basis of fear of making a mistake. Making people scared about tax isn't really a very effective way of dealing with tax. So we've always focused on helping people be compliant, giving them the tools and the skills and the equipment to be compliant, rather than putting the fear of God into people. If you do it wrong, this might happen. That's always been our approach at Fiscal Reps, and I think that's always going to continue. So the purpose of the next half an hour isn't really to sort of, as you say, to terrify you into what might go wrong, but just to sort of give you maybe a broader picture of how tax compliance, in terms of your organisation's affairs, it can impact your business on maybe a wider scale, and some of the things you need to look about. And also it's a result of our involvement in the insurance industry for a number of years as well. To give you an example, we attend conferences, typically kind of risk management type conferences on a regular basis, and we exhibit and we attend, and so we get to speak to risk managers a lot. And without having any kind of expertise when it comes to risk management, there's obviously, within every organisation, there's different risks that they need to manage, and they do it through insurance or through other mechanisms. And premium tax is probably another risk that needs managing effectively within your organisation. So this is kind of the concept that we're trying to share with you today. This quote here, I think, is, the price of inaction is far greater than the cost of making a mistake. I think what we're trying to say here is in terms of your compliance, in terms of managing this tax risk, is to take positive steps. Whatever those steps are, take positive. If a positive step is to do nothing, at least it's a positive step. I think if you sit there and don't make a decision, or leave it to chance, or leave it to inertia, then I think you probably are storing up problems for yourself. But whatever you do it kind of positively and kind of with meaning, I think. So as I said, we attend all these risk management conferences, and we sit in on their sessions, and we sort of become a part-time risk manager on occasions. And so four steps that I've sort of become acquainted with is this, in terms of risks, is this ability to either avoid a risk, to mitigate a risk, to manage a risk, or to transfer a risk. Obviously, to avoid tax risk, you just stop writing business. But I don't think that's particularly a sensible course of actions. But in terms of mitigating, managing, or transferring risk, there are mechanisms available. We provide a range of services which will sort of fall into any one of those categories. So, we can provide you with information, we can help you with the processes and the checks and balances, and we can actually do the work for you as well, which is kind of, maybe more of the transfer of risk. We take on the risk of doing and submitting the tax returns for you. So there are elements of what we do which kind of help this idea of kind of tax risk management. So there's kind of two costs, really. There's sort of the non-financial aspects, and then there's the financial aspects of kind of tax risk management. So the first ones we've got here are the non-financial costs. As you can see down the right-hand side, we did a quick Google search, and although it's not IPT, this idea of tax avoidance is, there's a lot of media scrutiny at the moment, and journalists are interested in these large corporates and their tax affairs and what they're doing. Typically, they're doing them legally, but it seemed to be, sort of unhelpful to the country as a whole, I guess, and the OECD and transfer pricing and all these sort of issues are becoming more and more to the forefront of corporations generally. So in terms of sort of a tax risk, managing tax risk, I've identified sort of four areas here really that we need to concern with. So there's your reputation with your customers in the market. There's your integrity with the tax authorities, audit concerns, and kind of employee-related issues. So in terms of customers and market, it's simple things like, well, if your policyholders or if your brokers, if they doubt your tax calculations, or they're in conflict with you constantly over tax calculations, that may cause an issue. It may drive business away from you to one of your competitors. But also, if you do make an error, how do you rectify that with your policyholder or with the broker, and how do you get those taxes settled with the tax authorities or reclaimed if there's an overpayment of tax? In terms of tax authorities, what we're seeing is a much more kind of focus on behavioural aspects of tax compliance. Are you a repeat offender? Are you constantly kind of making regularisations? Are the amounts large? These are kind of things that trigger the interest of tax authorities and want them to become, they take a keener eye on your tax affairs. So again, it's these kind of things where I think if you are prone to mistakes and your systems aren't quite perfect, you tend to get a lot more interest from the tax authorities than if you're running a tight ship. Obviously, internal and statutory audit concerns, the amounts may be material. I think typically premium taxes probably aren't material for the purposes of an audit, but in some cases they may be material. But it's also, it's more the general control environment as well. A part of an audit is to test the controls within the business. And if the controls around tax aren't adequate, that's an issue for an audit concern. And then finally, the tax team. If the tax team are constantly get it in the neck for something that the underwriters are doing, maybe, it kind of, demotivates the staff. It causes friction within the business as a whole, and there's kind of those issues there. You may suffer from staff turnover as a consequence or just conflict internally. So there's a number of kind of non kind of financial costs associated with making tax errors or maybe having kind of less than 100% effective tax systems. In terms of financial costs, again, I've got a few examples here of the kind of things you could do wrong. So again, statutory charges, you've got a risk premium you quote to the client. Are you including all those statutory charges in the premium that you charge the client? I'm thinking of things like there's the ASF levy in Portugal, the 0.242. There's various fire brigade charges that you can't openly bill onto the client, but you need to include it within the premium that you do quote to them. So make sure you're adding them in. You've identified them correctly and you've included them in the quote. There are some taxes you can openly bill onto the client, so make sure you are billing them on properly and you're fully disclosing that and you're making sure that the cost is being passed on to them correctly. Interestingly, there's in certain countries there may be an issue where if you haven't added the premium on, or if you haven't added the tax on, you haven't made it clear on the invoice, the premium is deemed to include the tax. So there could be a sort of a tax loss there as a consequence. Simple things like having out-of-date information. As we've seen earlier today, and we're constantly seeing tax rates have a habit of changing, and often they change quite suddenly. So it's important to keep up-to-date information. I heard a story a number of years ago of a particular insurer who, they had a spreadsheet which had all the up-to-date tax rates in it at a particular point in time. They emailed it around the office to share it, and I think within 12 months they had about 25 different versions of the same spreadsheet. None of them were the same as each other. They're all working off different versions, and that's where the ability to hold correct information centrally becomes very important. So everyone's starting from the same basis. Insurance products can be very complex and they can involve different types of coverage. And again, it's important to be able to understand what the coverage is because the tax rules differ depending on the type of business you're writing. If it's marine liability or general liability or property or business interruption, these all can have different tax implications in different territories. So it's important that you can identify all these things and make sure that you're attaching the correct tax rate. You then have to deal with the debits and credits. Somewhere in the system you have to do the tax calculations and then you have to record them in your books and records. So you have to sort of account for your tax liabilities and then make sure that within your accounting system you're discharging those tax liabilities correctly. So you have to accrue for them, pay them on, and make the right payments. And if there's if the connection between maybe the policy admin or the underwriting system and the accounting system isn't perfect, there could be differing results there, or things may possibly leak through the system. So again, I think it's important to have the correct systems in place, or it could cause you a tax loss. Reconciling your tax payments back to your general ledger at the year end, maybe, or your balance sheet at the year end, to make sure that all your liabilities have been settled and cleared. That may be a simple task to do to make sure that everything's correct. And then finally, you may do all the things above. You may have a perfect system of controls, up-to-date information, but you just forget to file a tax return. The person who's in charge of filing German tax returns takes a day sick. You know, they can't get in, their train's broken down, or they're on holiday. No one else knows it has to be done today, and it just gets missed. And you know, there's a penalty. So it's having those kind of backup systems, being clear of what the deadlines are, and making sure that there's always, you know, a number 2 person or a number 3 person who can pick up, you know, and run with it if that particular person is absent. You know, as you can imagine, within our office, you know, these deadlines are, you know, we live these deadlines every day. So you know, on the course of every month and changing regularly throughout the month, it's making sure, you know, Mike's down to sign the French tax returns tomorrow. Mike needs to be in the office. If Mike isn't in the office, make sure Susie is, or Ladislav is, or one of the other guys are around. So it's always having 2 or 3 people sort of, you know, who can step up, know what to do, and can do it so that we don't miss any tax deadlines. And that's an important bit. You can do everything else right, but if you make the payment late or you miss the filing deadline, you know, you could well suffer a penalty. So there's a number of issues there. So thinking about the finance costs, or the financial costs. So within the EA or EU-EA zone, property casualty rates, you know, typically around the 10 to 20%. I think in a number of, you know, people have attempted to sort of establish what the average rate of tax is, or IPT is in Europe, and I think it tends to be around about sort of 10, 12%, maybe a bit higher if you include parafiscal type charges. But it seems to be going up. Obviously the UK rate has gone up. The Dutch rate jumped up a few years ago. So, you know, the rate of IPT is going up, which means the average rate is going up. So, you know, typically I think we're talking about 10 to 20% tax on a premium. Motor policies are probably about the same. Maybe things like marine aviation, sickness and health are probably lower, simply because there's often more exemptions available there. So if it's international business, you often get a better exemption. If it's sickness or health, often through a sort of a social legislation, the tax rates are often lower as well. So the tax rates do vary, and I think it is hard to establish an average rate. But for the purpose of today, we're sort of looking at probably around 10 to 20% as an average rate of tax. So in terms of penalties, for a single offence, we're probably, again, looking around about maybe 5 to 10% of the tax that should have been declared as a penalty. Again, it does vary from country to country. But what we are seeing is this focus on kind of behavioural aspects of tax compliance. So yesterday I had a quick look on the HMRC website, and there's kind of 3 classifications of tax penalties within HMRC. So there's lack of reasonable care, there's deliberate, and then there's deliberate and concealed, which are sort of varying degrees of seriousness of offence, I guess. So if you're deemed to have not taken reasonable care in submitting your taxes, you could have a penalty of 0 to 30%. If it's a deliberate offence, it's 20 to 70%. If it's deliberate and concealed, it's 30 to 100%. Quite the difference between deliberate and concealed is, I guess there is a difference there, but I think it's behavioural. It's kind of, you know, I guess the number of errors you've made, the quantity of errors, and just your general attitude to tax compliance. But so you can see penalties can increase quite quickly if you're a repeat offender, if your systems aren't very good, and if the tax authorities deem that, you know, you're a difficult taxpayer, the penalties can start to stack up quite quickly. So on top of any taxes you have to pay, the penalties can be substantial as well. And I think it's always worth kind of bearing in mind, we do what we can when negotiating with tax authorities to get penalties revoked. You know, one of our sort of primary focuses really is working with our clients. So if there is a regularisation required, we'll go to the tax authority, we'll negotiate with them, we'll try and get the penalty revoked. More often than not, we are successful in getting it reduced, on the basis that going forwards, everything will be done properly. So there's kind of, you know, almost we'll clear up whatever it is now, and then we'll do it properly going forwards, and that often works with a lot of tax authorities. But there's some who just automatically levy a penalty, and again, this behavioural aspect, I think if there is, you know, kind of repeat offences, it's something that tax authorities are probably looking much more closely at than they probably did a few years ago. So it's always kind of important to kind of bear that in mind. So I'm an accountant. I work in the tax industry, but I'm an accountant, so I do like numbers, and I like ratios and calculations and profits. Profits are always good. Everyone likes profits. So I did a little bit of a calculation. Now, this is a very simplistic calculation. So it's designed to kind of demonstrate the concept rather than to prove a particular scenario. So if we say the average rate of a property casualty type risk is 15% across Europe, maybe slightly high, maybe nearer to 12 than 15, but 15 is a nice easy number for me to work out. So if you say that the average rate of tax in Europe is 15%, for every 100 million euros of premium you write as an insurer, you have this potential premium tax exposure of around about 15%, which equates to about 15 million euros. Now, if you do everything correctly, there's no direct cost to you, because you bill your taxes all onto the client correctly, you collect the taxes from the client correctly, you settle them with the tax authorities online, there's no net cost to you. You've included them within all the calculations and you paid them. So there isn't a direct cost to you if you manage it correctly. But if you make a mistake, so if you've under-collected taxes, for example, or you've forgotten to add on those parafiscal charges in your premium calculation, the premium you collect in, you're ending up, there's an additional cost you're paying to the tax authority. Some of the premium you've collected, you're paying away as a cost to the tax authority because you've made a mistake in your tax calculations. So it could become a direct cost if you get it wrong. Now, there is an indirect cost, obviously, because you need to, the problem with being the taxpayer is you have to maintain the systems to be able to collect and settle these taxes. So there is a cost of building and maintaining the admin function around doing these taxes. But say if you get it done correctly, there is no kind of direct cost to you as a business because you can just pass the taxes through effectively. So that's kind of the first kind of principle here. The second, looking at combined ratios. So again, a combined ratio basically, for an insurance company is a measure of profitability for an underwriter. So essentially, losses plus costs divided by premiums is the kind of the standard calculation. So if you've got a combined ratio of less than 100%, you're making an underwriting profit. If you've got a combined ratio of over 100%, you're making a loss because your losses plus your costs are more than your premiums. Again, it is a very kind of simplistic ratio, and I know a number of different businesses will employ different methodologies to calculate that ratio, but it's kind of, as a basic principle, that's what the combined ratio do. Within the sort of the direct insurance market, sort of typically within the UK and within Europe, combined ratios tend to be in the region of, say, 93 to 97%. So underwriters are making profits, but margins can be quite small. If I just jump forward a page. So what we did here, we took data from the top 100 UK insurers. I think this came from the Post magazine, the issue a couple of months ago, where they did a table of the top 100 UK insurers, and we worked out, because they gave us premium values and profitability and profit values for each insurer. So we worked out a kind of a basic combined ratio to see where the profitability of those insurers lie. And as you can see from this kind of curve here, the typical range of profitability or combined ratios was in the sort of the 90 to 100% range. Most of the insurers kind of fell within that range. Obviously, there's some making much better margins and there's some making much worse margins, but that seemed to be the average kind of area for the UK insurers. Again, I guess on a global basis, it may be different. European, it may be slightly different. Within the top 100, there's a lot of businesses writing all kinds of different products. So there were sort of variations within that. But again, trying to keep it as simple as possible, that was kind of the area of profitability that seemed to be the target for most insurers. So going back to the combined ratio. So for every 100 million of premium written, insurers' underwriting profits are around about 3 million to 7 million euros, typically. That seems to be what the maths is suggesting to us. Now, the interesting thing is that 3 to 7 million of profit, that's a profit to the business. You're all employees within that business, so to a greater or a lesser extent, what profit the company makes has an impact on you. As I said there, you may have a company bonus pool that's driven by the underwriting profit, so your year-end bonus might be determined by how much profit the company makes. You may have shares or share options in the company if the company's quoted, depending on how much profit they make. The share price goes up or down. You may be directly appraised based on the performance of the business. So these ratios, they do impact you in your day-to-day working environment. They probably impact everyone differently. In terms of what you do, and does it impact you? Yes. Do you impact that figure as well? Probably yes as well. What you do probably has an impact on that figure as well. It may have a small impact or a large impact, but ultimately they're all commercial organisations. We're all here to make as much profit as we can. When margins are tight, a significant event can have an impact on profitability. So going back to the combined ratios, as we can see there, if the typical combined ratio is, say, sort of 94 to 97%, what you can see is a small margin. So a single large event can have an impact on the profitability of an underwriter. If you consider, a large claim, obviously insurance companies have, they're able to mitigate, claims through the capital markets or through the reinsurance markets. Don't ask me how. That's kind of not my level of expertise. But they can manage their claims risk and their underwriting risk. In terms of business costs, cost control, budgetary factors. They you can control direct costs within your business. But as I say, this tax cost, it could have an impact on the business when margins are this tight. A tax error could have an impact on the business. So to take that example a bit further, and as I say, I don't want you having a sleepless night. This is just for fun, not for real. So, so if your annual premium is 300 million euros, and we said the average rate of tax is 15%, you could have a potential exposure within your business of 45 million euros. If you've got a combined ratio of 95%, which is about the average, what we've already determined, you make an underwriting profit of 15 million euros. So your potential tax exposure is 3 times your underwriting profit. Now, you're not going to make a mistake of 45 million euros in one go. But, a factor of 45 million euros could have an impact on your profitability. So what I worked out here is a 5% tax error, so a tax error of just over 2 million euros, which relates to 5% of the 45 million, would reduce your underwriting profits by 15%. So a 2.25 million tax error will reduce your profit from 15 million to about 12.75, which is a 15% fall in profits. Again, a 2.25 million euro error is a substantial error. It's not, it's something that, it has happened, and it will probably happen again. It's kind of, low frequency type of event, but it may be more likely there may be a number of smaller events that add up to a significant value over a period of time. If they all come to fruition in the same calendar year, then you've got a potential problem. So again, it's not really that big event, but it's maybe a combination of smaller errors and events that all end up being treated in the same year that could build up to a significant kind of a figure. So your profit is reduced by 15%, and your combined ratio has gone up from 95 to 95.75%. So you can see how, at a kind of a higher level, at a strategic level, if you like the board level, these errors can impact the company's performance, the company's profits, and it's kind of, and I think this is where there's probably pressure on tax people, maybe without the resources, because you're dealing with this big potential exposure, and you're expected to deal with it. And if your resources or your teams are stretched, you're dealing with this exposure maybe without all the support and resources you require to kind of deal with it effectively. So I think it's as I said, it's designed to be an example. It's not designed to send you home in tears this evening, have a sleepless night worrying about it. But that's where I kind of feel it's the risk management aspect of tax becomes important. If you do have a potential exposure, think about what you need to do to be managing that risk effectively. And there are things you can do to manage that kind of risk effectively. In terms of managing a risk, you need to identify what the risk is, quantify what your potential exposure is, and then do something about it, take steps. So if you've identified that your potential risk maybe isn't 45 million euros, it may be 10 million euros, you can then decide, okay, well, it's 10 million euros. how much resource do we need to throw at a 10 million euro potential risk? What do we need to do to mitigate that as far as possible? Is it something that's really, really unlikely, so we don't need to do anything about it, or is it something we think could happen, so we need to do something about it? But without doing the maths to start with, you can't then begin to make sensible decisions about how you manage that risk going forwards. I think that's probably the key kind of message here. When we did a tax survey just before this event, I think probably earlier in the month, and a couple of questions in the survey asked about whether people have tried to calculate what their exposure to premium tax is. And I think over half of the respondents had said, to their knowledge, no calculation had been attempted to establish what their potential exposure to IPT was as a business. It's probably not too difficult to do some basic maths and to figure out what your exposure could be. And maybe it's something that the board or your manager would be interested in seeing, so they can look at this from a different angle and say, okay, well, there is an exposure here. There's something as a business that we need to be looking at. And we can manage it, knowing about it means we can manage it more effectively. So maybe there is an element of work to be done here. Just to kind of conclude, again, there's a few other bits and pieces just to leave here, really. So, again, in terms of not paying your taxes, if you don't pay your taxes, and I'm thinking like the Consortio in Spain being a good example, if you don't pay those levies, the eligibility of the policy may be in doubt. You may not be able to make a claim from the Consortio if you haven't settled the Consortio taxes correctly. Obviously, the media scrutiny of this sort of corporate tax avoidance, I don't think it's going to go anywhere for the time being. I think the journalists are interested in anything they can find about these kind of areas of avoidance. So again, from your corporation's point of view, it's making sure that you're seen to be compliant rather than just being compliant. It's probably you're seen to be compliant as well. So you're demonstrating your good corporate citizenship and doing the right thing. But also as well, it's the management time cost. So if there are problems and there's kind of leakages and there's errors, it just takes up a lot of management time dealing with these things. But if you've got a nice, efficient system that works day in, day out, month in, month out, the management time required is significantly reduced, and you can focus on your day jobs rather than having to sort of deal with these problems from time to time. So kind of the thought for the day is, what effort is required to manage your premium tax exposure? I can't tell you what the answer is because it's different for every company, but I think hopefully, if nothing else, I've kind of provoked a thought in your head maybe that you can take back to your office and think, well, okay, is this something we need to be managed? Is it being managed? If so, great. If it isn't, are there a few simple steps we can do just to make sure that there's more of an identification of what the risks can be, what can go wrong, and if it does go wrong, how much will it cost us? So it's really kind of hopefully you taking that thought away with you today. Just to conclude, I mean, there's 4 quotes here that came back on our survey, which kind of, I mean, you can read the quotes yourself, but I think what they're suggesting here is if you build your taxes into your systems, the chances of making a tax mistake significantly reduces. So if you can build rate tables into your underwriting systems, if you've got a reliable system that identifies the current rates of tax and applies them consistently time and time again, if you've got robust systems to make sure that when the data is being entered, it's entered correctly, those simple things will go a long way to reducing that exposure to an acceptable level. And as I say, these were just the 4 quotes, or 4 of the quotes that we got, which I thought was kind of quite relevant. On that note, I'll conclude. I think we've got another session coming up. As I said, it's an example to provoke a question rather than an example of what will happen if you don't do things. So for some of those examples, it's relevant for your companies. For some of you, it isn't. The numbers are different. The risk appetite is always different. But I think tax risk is something that, managed correctly, it could well save your company some money in the long term and boost your profits. And everyone is happy if it's done properly and your company is achieving the margins it wants to achieve. If you do have any questions in regard to this, maybe catch me at lunchtime, and I'm happy to kind of talk through the maths of it in a bit more detail. And also just, if any of you do this kind of exercise internally already, I'd be interested to hear how you do it and what the results are and what your conclusions are drawn. I think it's something that I'm interested to kind of research a bit more. So if any of you do have any kind of first-hand experience of doing work along these lines, please call me at lunchtime and sort of talk me through what you do as a business, because I'll be very interested to hear more. Okay, thank you very much for that. In terms of the next sessions, there's 4 sessions. I think it's a repeat of this morning's sessions. So we've got the expanding the scope of IPT in room A, which is that one there. IPT 101, which is the first room on the left, room B. Italian reporting, which is room C, which is second on the left. And then the location of risk ruling, which is in room D downstairs. After that, I think we can stop for lunch and maybe have a glass of wine or something to refresh ourselves after a busy morning. So once again, thank you very much and hope to speak to you all at lunchtime.